Hey everybody, this is Jose. How are you, everyone? Good to see you, my friends. Ready to get started here. Let's have a quick sound check, as we always do before we start the sessions. A quick message on the chat box would do. If you're new, this is what we normally do at the beginning of the sessions, where we just say hi on the chat box, and that tells me that you hear me, so sound is good, and we are ready to begin. We got 20 plus seconds to go, so let's go ahead and say hello in the chat box. Thank you so much. I'll just be waiting here for another 20 seconds and we begin. Thank you, guys. How are you, Jeff? Good to see you. Thanks for that. Very good. Almost time to get started. Here we go. Top of the hour. Hey, Joe, how are you, my friend? Good to see you as well. Very nice to have you, as always, joining me in the live sessions. Welcome to the live session, everybody. Today is April 7, 2022. This is Options with Options, and my name is Jose Blasco. If you are new to the sessions, well, I guess the name says it all. We're going to be trading options. We're going to be looking at the options markets, finding options opportunities, discussing options trading, and all of the above. Before we get started, a quick disclaimer on the upper left side of the screen. Disclaimers are important information, so I'm counting on you to read it completely. It is fairly short, so please read it carefully because I just said it's important, so please do that. How are you, Christian, Ahmed? Good to see you guys. Very nice, very good. So the disclaimer is done, and we are ready now to begin. Okay, so let's jump in the markets and let's begin our analysis. So here's top. Today, just for fun, I'm gonna start. How are you, Mark? Today, just for fun, I'm gonna start looking at the VIX. Okay, let's take a look at the VIX so we can see what are the VIX values at this moment in time. We can see the VIX went back up after a pretty interesting drop, hitting the level of 19 more or less, even 18 something, and now the VIX is trading almost at 23. Okay, so of course this has to do with the fact that the market has been falling for a few days now, and obviously many people get concerned, and this is the classical reaction, the classical, inverse correlation that we can see in most of the times between the VIX and the S&P. So what am I trying to say here? Where volatilities are not as low as they were when we met last week. Okay, so that will lead into a conversation that I'm going to have now in a moment. After I do the market analysis of the SPY, I just switch market symbol from VIX to SPY. As you can see on the screen, we are now looking at the S&P 500, and notice what's happening here. Okay, so what's happening at this moment in time is that we are in a confirmed down climate. Okay, we are in a confirmed down climate. So this climate has been moving down for 2 days, and it's confirmed, which is relevant. Okay, meaning that, if we were to find trades to the short side today and we wanted to execute just trades, it's a valid approach. We are within the climate, so it's a valid approach to enter those trades. But at the same time, careful here, because look at what's happening. The implied volatility of the calls as an average in the last 3 days is significantly higher than the puts at this moment in time. While the climate is down, the calls are much higher than the puts. Okay, so when looking at the volume map, we can see that intraday here, the implied volatility of the calls is also greater than the puts. Just like in the 3-day average, the implied volatility of the calls is greater than the puts. So there is a lot of call buying or put selling from behind the scenes, which both are very bullish actions. And the reason why I'm pointing at that is because the statistical duration of this down climate is 3. We just hit 2. So I would say the expectation will be to see that climate turn fairly soon. 1 more day, 2 more days, something like that. That would be my expectation. And the reason why I'm, quite bullish on this approach, if you wish, is because, the difference between calls and puts from an implied volatility point of view is quite significant while we are in a down climate. Okay, so in that sense, from behind the scenes, there is a lot of intention for buying, unless something crazy happens in the markets and that intention evaporates and everybody cancel the orders just because something crazy happens in the world. Then of course the market can continue falling. But based on statistics and based on what we see building up from behind the scenes in the options arena, there is a powerful bullish sentiment that is building up. Okay, now we don't see it yet when it comes to trade activity. Still, we got gray color: 1.2 for the put, 1.5 for the put, 1.1 for the put, 2.0 for the put. So it looks like there is a lot of put trading, put volume. But given the fact that the implied volatility of the calls is greater than the implied volatility of the puts, the interpretation is that those puts are being sold. They are not being bought. They are being sold. And therefore, again, that bullish sentiment is building up. Okay. We are also reaching 5-day average. We've been trading just for a few hours since the market opened. Not even 2 hours. And we're already reaching the 5-day average. So again, decent, very decent. That's going to be powerful to see if that climate changes from red to blue and the implied volatility of the calls remain above the implied volatility of the puts. That's going to be a very, very powerful message the market is giving us after plenty of failed blue climates, right? Plenty of failed blue climate, which statistically should last 6. We had a very powerful blue climate that took place. If this down climate now matches its expected behavior, and then we get blue again, so that next blue climate could turn out to be quite powerful because the market is proving itself that it wants to go up. Plus, from behind the scenes in the options markets, we can see that bullishness building up based on the tools we have on the screen. Okay, so now having said that, we are still in a down climate. Okay, we are still in a down climate. So the right action to be taken is to either still find some shorts, which of course you don't want to load your portfolio with shorts, knowing that technically, potentially a blue climate is around the corner. But if you have some long positions and you haven't entered any sort of a hedge, or some of your long positions meet target and you got out of it, or maybe some of your short positions, like for example, the one we had on Lennar Corporation that we entered the other day that went down and hit your target and you're probably out, meaning that let's say you had a portfolio with multiple longs, you enter Lennar Corporation as a hedge in case the climate was to become red, and it did. And you got to the target, so now you're out. So if you are out, that means that you are not hedged anymore. So again, the S&P climate being still red certainly still invite you or give you the opportunity to find valid opportunities to get short, which we'll try to find today as well. But again, I would look at it like with a limited quantity of deltas in your account because we are getting close to the end of the climate, plus with all this bullishness coming in with the implied volatility of the calls above the implied volatility of the puts. So we can see a change of climate, and you don't want to load your account with short positions when a complete change of direction may take place. So long story short, my preference as a trader today will be to find opportunities to enter short with limited position size, limited deltas because of what I just explained, so I can manage my portfolio and be adapted to the market condition as much as possible. But also, since the implied volatility went higher today and is now trading close to 23, so the other thing I would like to explore is to do iron condors, okay? Because we are now in that place where the climate is about to get undefined. 1 day later, it's going to be a 3 out of 3. So what do? You go short, you go long, too late to do everything, too soon to go long, too late to go short. So what do? Iron condors, non-directional strategies are a good alternative, plus implied volatility is high. So indeed, I would like to explore that if possible, together with some shorts. But before I get there, of course, we'll need to do our review of trades, and we have work to do here because there are trades to be closed, there are trades to be maintained, so we need to talk about all of that. Guys, you've been silent there. Fair enough. I've been speaking non-stop, as always, a bit on the fast speed mode. But I'd like to get a little bit of feedback, if that's okay, even if it's just a quick okay or good, something like that. Please type that on the chat box. That helps me a lot. If you have any additional questions, opinions, concerns, anything, this is the time to phrase it. If you are new to the sessions, please do not be shy. If you are watching this recorded and you are new to the sessions and you're like, okay, I have questions, but I'm watching this recorded, what do I do? Shoot an email to us, use the questions page, right? The questions page would be, let me put it on the screen, tradewithufos.com/Jose. So you get in there, you post your questions, and our support team will get back to you with answers. So you can be in tune, no matter if you had the opportunity to watch this live or recorded, but make sure that you communicate, guys, so that way we can help you better. Good, all good, everyone. Thank you, Mark, for the kind words, and everybody's good, and Christian is okay as well. Perfect, wonderful, perfect, perfect. Good. So let's do a little bit of a review now. Let's review our positions. So we'll start with GE. Okay. So GE, as you can see, if I was to right-click and get the risk graph, we are using April 29 expiration combined with April 8 expiration. Well, if you recall, this is a double calendar, okay, which currently it's net producing $8 of profit based on the theoretical values here. If I bring in Thinkorswim, GE shows negative $72 of profit, meaning it's a $72 loss, but that's not accurate. This is what we currently have in the account without accounting the prior roll that we did in the prior week when we took the April 1st expiration and rolled them into April 8th. So net, if you add everything, we are making $8.5 in this trade. And the question is, what are we going to do now? Is it time to roll those April 8 into the next week, or is not? Again, it's a double calendar, and talked about the maintenance and the theory behind how to maintain this type of trades in prior sessions. So I won't do that today, just to save a little bit of time on the explanation and get to do what we have to do. If you know why I do it, so I would welcome you to go watch prior recordings. So that way, hopefully at the end, I can have time for some trades as well, okay? So anyway, so this trade is made of, as you can see, using the 98 and the 87 strike, which obviously I don't have this properly documented. I guess I made a mistake here when documenting it. Is 98 and 87, and you know that stock is currently trading at 87, 88, so pretty close to the put side, very far from the call side. So what should we do? Okay, what should we do? Should we roll or not? Okay, so let's go ahead and explore the option chain so we can see if we are dealing with distorted Greeks already or not. So the current expiration date is April 8. The next expiration date is April 14. That's all I need to check. And the strikes I care about are the 87 strike and the 98 strike. That's all I care about. Okay, so I just highlighted what I care about. So now let's take a look. Okay, so the 98 call, okay, is currently giving us a theta of 7 cents. That is the theta provided by the 98 call. Now, this option expires in 1 day. So 1 times 7 equals 7 cents. But the current price of this option is 2 cents. So theta suggests you're going to make 7 cents sometime decay, but it's obviously impossible because the only premium left is 1 to 2 cents. So in other words, we are dealing with distorted Greeks, and therefore it's time to roll the 98 call. Okay, it's time to roll. Having said that, it's going to be a tough one because notice that the 98 call on the next expiration date is basically paying nothing. Okay, and why is it paying nothing? Well, it's paying nothing because that stock has been dropping significantly, and therefore that call got very little premium left. So the way to take care of this, it's by letting the 98 call expire and then sell a new one on the next week with a bid of minimum 15 cents. Like, by the way, it happened on Harley Davidson. If you are in this trade, you know what I'm talking about. If not, I will review it in a moment. So on Harley Davidson, we got exactly that same case last week. Okay, let me, in any case, just to go through the process. So if you were to look at G, you were to look at the 98 call that expires in April 8. You were to right click and create a rolling order. Waiting for data. 1, 2, 3. Come on. I'm not sure why in such a long time to do the roll. Okay, I guess we have to wait. But anyway, you will see that basically if you need to pay 1 to get out and you're going to collect 4 to get in, basically you're going to make 3. And for you to make $3, you need to pay a lot of commissions. So when that's the case, it's not worth it. Okay, so not sure why it's taking such a long time to load. Reconnecting, it says here on the top. Okay, so I guess there is a problem with the TOS. So let me close this platform. Let me restarted. Maybe there is something that was not properly initialized. So, okay, so it's installing updates on my other computer screen, so we'll come back. But anyway, so bottom line, there is no premium. So the way to do it is leave it alone, let the 98 call that expires in April 8 expire, so you don't pay commissions to get out, and you make the 1 cent left. And then next week, sell the 98 call, and ideally the stock will have rallied a little bit, so hopefully you can grab 15 cents. And if not, just be patient until you grab 15 cents. But, I rather don't do it. And when I do it next week or the week after, two weeks later, I do it for a bit more premium than doing it now, and I get 3 cents, and then I need to pay $2 or $3 in commissions, and basically I'm getting nothing, right? So it's really beyond inefficient, right? So you would not want to do that. So I'm just typing my credentials on TOS. Hopefully it will reload now quickly. I'm not sure what happened, to be honest. Let me see. Okay, we're almost there. Okay, I believe it's almost ready. Like maybe like 80% loaded. So we should see it on the screen fairly quick. Should be quick. Come on, TOS. Okay, coming in. Okay, here it is. Okay, so anyway, so I'm just gonna click on it, select April 8. Okay, ready to create a rolling order. Okay, now it's more normal. So when I click on that, you can see you would basically make 4 cents maximum if you did that. Okay, so I'm not gonna do it. Okay, this is the same that happened with HOG the other day, and therefore the action would be to look at April 14. Okay, find. I'm just gonna go ahead and click on any random call, make it the 98 call. Okay, so find the 98 call. We want to sell one of those calls. Of course, one, because everything I'm doing is with 1 unit when I do the session with you guys. If you're using larger size, of course, it's going to be more than 1. And I'm just going to make this to be 50 cents. Okay, I'm going to make it a good till cancel. Okay, and I'm going to move this to be something that I want to do only if submit on Monday after Friday 8 expiration, which is Monday 11. That's when I want to submit that order. Let's do it, a little after the market opens. Let's say, 35, something like that. It's not critical because we're using a limit order, so it's not like we're going to get slippage. But anyway, so save. I'm placing that order, and that order on Leonard Corporation, your buying power will be 0 and A if this order is accepted. Okay, yeah, great, no problem. This is because this is not well calculated. TOS is not taking into consideration that. So my order got canceled here. TOS is not taking into consideration that what's going to happen is that I will be out of a short call, and then selling a new short call will take the same buying power I'm using now. So that error message is probably happening because it's a simulated account. In the real account, I should have been able to put this order in. Okay, so anyway, so I'll leave it there, and I guess I have to do this manually and remind myself of doing it. But since I did it last week, and and now I re-explain it, hopefully everybody's okay with that. Okay. Joe, the long call will begin decaying rapidly in a few weeks. How would you justify 15 cents against that? Well, because I've been doing 15 cents every week, and because the long call will actually be decaying, but also will be gaining value with the increase of implied volatility as we are approaching the earnings report. So the earnings report is going to offset the theta, unless it was going to be the most boring report in the world that no one cares. Typically, you would see the options price to rise way more than what you lost on time decay. Okay, so we're going to be okay with that, Joe. We're going to be okay with that in most of the cases. Again, let's say the market was to go like flat, like boring, like no expectation, like the S&P moving 0.1% a day. So then, yes, those trades would end up, losing a bit. But if, and notice I said a bit, because already the initial risk we had, since we've been in those trades for a few weeks and we've been rolling 2 or 3 times already, so now the risk left on those trades is very little, right? And just by a little bit of a rise of implied volatility, you're going to be in a very nice profit, okay? So anyway, we cannot do much on the 98 call on G. We need to watch it manually. You need to remember on Monday 11 to go there and place an order to sell the 98 call. Okay. And from a put side point of view, we got the 87 put, right, which is close to at the money because the current price of GE is 88.02. So we are close to at the money. So here the theta is going to be bigger, which is 37 theta. Okay. And here the bid and the ask is 44 to 40. So because we are closer to at the money, we don't have distorted Greeks yet. Remember what we said in prior sessions? The further you are out of the money or the further you are in the money, the more distorted the Greeks. The closer to the money, the more in line with reality the Greeks will be. And in this sense, you can see how theta suggests 37 cents, which is less than 40 something cents. And therefore, we'd still benefit from not rolling yet. I'm gonna roll because I won't see you tomorrow, and I want you to see me do it. But technically speaking, you need to keep double checking this, and potentially doing it later in the day or tomorrow would be better than doing it right now. If that stock was to rally by a little, just rally maybe 50 cents or something like that, so that 87 put will be a bit deeper out of the money, and therefore you start getting distorted Greeks. And I'm pretty sure that if the stock was to rally 50 cents or $1, next thing you know, now you can do the roll right now. Okay, but technically speaking, so theta is 37, the midpoint between 38 and 41 is like 3. So we don't have distorted Greeks yet. By the way, notice how since we are looking at this was trading at 88.02. Now is 88.14. It went up just by a bit. And notice how now we got 36 and 40, 36 and 39, 35 and 39. The midpoint, guess what, is 37, which is already, well, actually theta now is 35. So it's still not distorted, but it's getting closer to being distorted. You see my point? So, great coincidence that this is happening now in front of our eyes. Hopefully helps you to understand this better. Anyway, I'm going to roll now. Okay, I'm going to roll now because I won't see you tomorrow and I want you to see how this is done. So I'm going to look at the 87 puts. I'm just going to leave a few cents on the table. It's fine. Right click, create a rolling order on the 87 put. Right? If I do this roll, I'm going to take in 78 cents. Okay, so let me just do it. And now let me simulate and show you why I'm doing it. What's the benefit? Okay, which many of you probably already know from prior sessions we had, but let me show you that. Okay, so back to here. We just got filled, by the way. So if I take GE, by the way, I got it already, right? So GE risk graph for GE is right here. So if I was to compare spread and copy the primary spread, right? And now, right? So let me pretend that 87 put, instead of April 8, now is going to be the April 14. Okay, it's going to be the April 14. Why? Because I just rolled it, right? So now I just got it, and how much I got it for? Well, I had to pay 37 cents to get out. I collected 115, so I had a net benefit of 78 credits by cents of credit by doing that. So let me grab a calculator here, okay, and do the math, because what I have on my risk graph right now is not totally accurate. I changed the date to April 14, but I kept the fill price for the 87 put to be 39. Well, guess what? The reality is that I got 39, but for me to get out of 39, I had to pay 37. That's the reality. For me to get out of 39, I had to pay 37, right? So really, the net profit I was left on that put is 2 cents. But then I sold a new one with 115, right? So basically, it's like I got this April expiration 87 put for $1.17. That's the equivalency, if you wish. So if I type $1.17 here on the put, okay, so this is now showing me the new risk graph, where notice what's happening on the reward and the risk side. So the risk of this trade before today was $280 per contract. The most you can lose now is $200. Okay, And now notice how the green zone is becoming larger and taller. Okay, and again, volatility is currently now 37.17. I wanted to remind you all, when it comes to GE, that earnings on GE are going to happen on 426. Okay, are going to happen on 426. So we are dealing with 429 expiration, meaning that before we get to 429, volatility will rise, and therefore that 37 volatility will go up by whatever. And notice what happens when volatility goes up. Look at the whole green zone that builds up, right? So that's what we are playing here. Okay, we are playing the rise of implied volatility, Joe. This is going to offset the theta decay on that call, as you were asking before. Jeff, you rolled at 80. Wonderful. Very good price you got, my friend. Fantastic. Love to see that. So anyway, so this is what we have now, okay? But at the same time, notice how it's a bit weird because, here you got, before rolling in blue color, you got 2 picks. After rolling in orange color, you got 1 pick. Why? Well, because we're still left with the April 8. Okay? So what would happen, okay, if I also convert the April 8 98 call? Well, the April 8 98 call, I cannot do it now because I would only get 4 cents, right? But if I do it on a Monday, I'm going to get 15 cents on top of the 79 cents I already got. So 79 plus 15, that's going to be 94. So again, if I add 94 here, okay, notice that now I'm back to having 2 picks. Okay, the risk now is 187 instead of 200, so even less. Okay, and again, same story. As volatility rises, the whole thing goes up. Okay, as you can see. Okay, and let me go back to 37.17, which is the current level of volatility. And yeah, so that's what we are playing. And again, after April 14, we have another week, and we're going to sell another option. And then we got April 29, we're going to sell another option. And as we are doing that, basically, we are eliminating the risk of the trade all the way, exposing ourselves to the increase of implied volatility. Okay, so just even though I said I was not going to repeat it, I was kind of repeating it very quick here, just to make sure everybody's with me, and also because of the questions on the chat box, just to make sure everything is clear. So this is, I'm going to copy this position to the clipboard, and this is what I'm going to put here after GE. Okay, following up on what we're doing with GE, with adding now the April 14 expiration options. Okay, so done with GE. Okay, done with GE. Now, what else is next? What's next is Harley Davidson, HOG. So let's take a look at HOG. And that stock, it's also, moving, doing its thing. And again, before we get to the expiration date, which in this case is 422, earnings happening on 418. So before that, notice that, everything is moving according to plan. Notice that earlier the red line was, deeper inside the cone. Okay. Now the red line is outside. What does that mean? Implied volatility has been rising. So what's happening to the P&L of HOG? Well, if I look at the P&L of HOG, so here it shows that we are losing $27. Well, the reality is not exactly like that, isn't it? When we look at positions HOG, when I look at the midpoint, so, well, actually, it does look like HOG is just slightly under the water. Let me actually simulate that because we see it better on the risk graph. Okay, so here's where we are. And yes, indeed, it seems that, so far we are a little bit under the water. But again, we still have a few weeks to go, and we're going to be selling more options. Okay, so let's see if Greeks are distorted, and we can do it again on HOG. So we are looking at 8 and 14 expiration, okay, and the strikes that we care about. So with HOG, we are dealing with 35 put and 40 call. So let's do that. 35 put and 40 call. Okay, and we're looking at the 40 call, so we can see here 10 to 9 cents. On the front week, actually, we also have 10 to 5 cents. So I guess it's going to be difficult to get out. In any case, let's take a look at the Greeks. So we have 20 cents of theta with 1 day to expiration. So we should be able to collect 20 cents, but there are only 10 cents left maximum. So Greeks are distorted on the call side. We would want to roll. Different stories. Can we roll? With those prices, rolling may not be an advantage. So we may need to do the same thing we did with HOG with the call actually earlier this week. So I'm going to check that in a moment. And with the put side, we are dealing with a theta of 18. So the midpoint between 10 and 20 is 15, which is less than 18. So the put also have distorted Greeks. And here with the put side, it's going to be easier to roll because the next week is providing 60 to 45 cents. So we should be able to do a more healthy roll. So let's do the rolls. Let's evaluate the rolls. I'll start with the put because the put is, I would say, a sure yes, go ahead for the roll, I would say. So let's put it in here and confirm I am correct. We're going to look at the 35 put, right click to roll. And here it says that if we do the roll, we get 37 cents. Okay, so indeed we are bringing in premium. So I'm just going to do it. And on the call side, while I wait to see if I get filled on the put side, when I evaluate the call side, and the call side, notice how the roll says the same we had before, which is, hey, if you do the roll, you get nothing. Okay, and this is because you need to sell an option for 10, you need to buy an option for 10, so you get nothing. Okay, so same story. What are we going to do? Leave it alone, let it expire, okay, and get an order to sell the 40 call that expires on April 14. Okay, sell one of the 14 April expiration 40 call, minimum 15 cents. This is the sale last week. Minimum 15 cents. Util cancel. In case you don't get filled on the Monday, you may get filled on the Tuesday or so on. That's why we wanted good till cancel and the submission date and time to be Monday 11 09 35 00. Save, confirm, and send. Okay, so I have my call order waiting there that won't be sent to the market until Monday 11. So we are leaving the April 8 expiration 40 call to expire. Okay, and we are making our life easy by placing an order that won't be sent until Monday, but is already in the platform to sell a new 40 call for 15 cents or more, like exactly the same thing we did this week. In the meantime, I'm waiting to get filled on the roll, which I'm not being filled. Again, I won't be patient because we are in the session together. I maximize the time with you guys. Please don't do what I'm about to do. I'm about to use a market order to get in. I may get killed on slippage here because HOG is not very liquid. Please make sure you negotiate your prices. Don't do what I'm doing. I'm just doing it so I can have it filled, so I can document it and therefore demonstrate how it's done. I got 30 cents. So let me bring the fields. Okay, here's HOG. I got 30 cents. Pay 20, got 50. So let's emulate this in top. So this is HOG. Compare spread, copy the primary, and do the same thing I've done. Okay, so the goal is to take those April 8 and move them, roll them to April 14. So the 40 call, I'm leaving it alone, and I'm going to get additional 15 cents next week. So that would become 0.75 instead of 0.6. And for the put side, which currently I got 35. So for the put side, for me to get 35, I had to pay 20, right? So 35 minus 20, it's 15. I mean, it's very basic math. And then I'm collecting additional 50. So that means that my net total amount of credit for the option is going to be 65. So I'm going to add here, instead of 35, 65, and click OK, and do the new trade that we are dealing with. Okay, so let me maximize this, and you see the benefit. So notice how we had a risk of 105. Now the most we can lose is 60, right? And now we were underwater with those peaks, kind of like the peak on the right was in the green area, but the peak on the left was below. Now we got two peaks clearly above the zero line, And of course, if volatility rises, which is the bet, now next thing you know, we're gonna be in business to make a nice profit on this trade. So again, we are exposing ourselves to that market opportunity. So again, I just did it, copy position to the clipboard, back to positions. I'm gonna place it under HOG. I did this analysis for HOG way faster than GE. Are you guys with me? Did I lose you? Do you want me to slow down because you are placing the orders and you want me to review my screen? Let me know. Let me know if there is any need out there. If everything is okay, please type a quick okay so I know you are with me, please. Thank you so much. And then I'm gonna move into AMD. Here we go. Okay, good, wonderful, perfect. Thank you, guys. Again, if you are new to the sessions or you're watching this recorded and you are like, this guy is flying for me, I need you to slow down, Jose, just tell me, please. Do not buy. All of us here in the room, at some point in our life, we were new traders. And, again, my job here is to be as efficient as possible with the use of time, but not to lose you. So if I'm losing you, that's bad. But if you don't tell me I'm losing you, then I don't know. So please communicate with me. Do not be shy. I'm here to help. Okay. So AMD is a trade that we initiated last week. Okay. This thing is moving, is doing its thing. In this particular trade with AMD, we are using the 124 and the 103. So we are using the 124 and the 103. That's what we're using. Okay. And let's see how it looks like on Thinkorswim real time. So AMD is looking like this trade is making $81. Why would that be? Well, probably the increase in implied volatility has been significant on that stock, which means that doing our role is probably going to be very, 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 very juicy. Okay, so let's take a look and see if that's the case or not. Okay, so let's get our risk graph for AMD. So let's load AMD on the option chain for April 8 and 14. And we are looking at, we said 103 and 124. So 103 and 124. Okay. This is what we have. Okay, 103 and 124. So let's begin with the 124. So the 124 shows a theta, calculated theta. Well, when a theta is not calculated, it's beyond distorted, it's completely, totally distorted. And the reason why it's not calculated is because there is no bid. Okay, so no one wants that. So, the good news is that for us to get out of this, we need to buy. So we're going to be the one bidding. So you could actually get out of this, even though no one is bidding. You got asked. So someone is asking. So you'll be able to buy it back. Even though it may take a little bit of a challenge. So here, you may place an order, and next thing you know, you need to wait until all the way Friday, and Friday is over, and you basically have not been able to be filled on the roll. This could happen. Why? That stock has been dropping a lot. Okay, and because the stock has dropping a lot, we are very far away from 124, and this option is very far out of the money, and because there is 1 day left, so basically there is no one wants it anymore. There's no premium left there. So, which is a good thing in the sense that you collected all the premium. So not an issue, okay? So again, we would love to roll that. Now, if we do it, we would collect, the difference between 12 and 1 is 10 cents. So it's not going to be a lot. But I guess, that's our only choice here because that's what it is. So we'll see that in a moment. When it comes to the 103 put, well, the current price of the stock is 102. So that option is in the money by $1. So we may not have enough distortion of Greeks. So the theta is 77 cents. Okay. And the current value of this option is $2.07. Okay. So obviously, if you look at it this way, you would say, well, yeah, there is, this is not distorted. 77 is less than $2. 77 cents is less than $2. So that's not distorted. Okay. But wait a moment. That option is in the money. Okay, so the difference between the current price 102.15 with a strike which is 103, that's 85 cents. You got 85 cents of intrinsic money minus the current value of the option, which is, let's call it 202, which is the midpoint between 20 and 204. So that's, sorry, I did wrong. Okay, like that is 117. So 117 is still more than 77 cents. So there is no distortion on the Greek yet. Why? Because we are relatively close to at the money. Okay, so that's why there is no distortion yet. Not enough distortion, I should say. For sure, there is some distortion, but not enough for us to call it distorted. So it's not time to roll. You will need to wait until tomorrow, etc., etc. Okay. Of course, these options in the money. So if you don't roll, you got distracted, you may get a sign. Let me not say may. You would get a sign for sure. So so we need to talk about that maybe. Just to make sure no one gets into a position where you don't know what's happening. Okay, so I'll explain it in a moment. But beyond that, I'm gonna roll anyway because I want you to see me do it for practice purposes. While it's not gonna be optimal for me and my results will be worse than yours, I'm still gonna do it. So for demonstration purposes and how it's done and process and so on. So you see it. Okay, so I'm gonna take the 103. I'll start with the put. Okay, so 103 put and create a rolling order to see how much I get if I do that. So that, it seems I'm going to get $167 of credit. Okay, so let's just do it. Okay, I'm just going to do it. Let's see if I get filled. If not, I will move the price. And I'm going to look at the call side as well. Again, the call side is going to pay me nothing. But let's place the order and see how much that is. It's 12 cents, as we kind of calculated. So let's put the order in. So we're going to get that. Okay, so I got my 2 AM orders there waiting to get filled. Doesn't seem I'm getting filled. Again, time is passing. We have limited time in the session, so I'm just going to speed it up. With a market order, please never do that. Do not use market order with options, okay? Okay, I just got filled at 165 for the put. Let's see if I can get the call. So then I can document everything, and then I'll talk about the assignment in case you were not to roll it, because I just said it's not the right time to roll, isn't it, for the put, okay? I'm doing it so you see me do it, but it's not the right time. It's not the optimal time, I should say. I mean, you could do it for sure, but it's not the optimal time, okay? Okay, I just got filled at 10 cents. Okay, great, perfect. Okay, so I got it. Very bad price, but I'm happy, so I can explain that to you. So let's begin with the put side. Back to top. So let me get my graph for AMD. Let me copy the spread. Let me copy primary. Let me edit. And again, what's the goal here? The goal is to get the April 8 to be April 14. Okay, that's the goal. So let's begin with the put. We got 89 cents on the put side. Okay, we got 89 cents on the put side. For me to get out of the put side, I had to pay 2. So minus 2. Okay, so I'm underwater by 111, but then I got paid 365, which gets me back out of the water by 254. Okay, so in other words, this option here from 289 becomes 254, okay, which is a nice amount of premium collected. On the call side, I had to pay 1 and I received 11. Okay, so on the call side, I had 46. To get out of 46, I had to pay 1, and then I received 11. So in other words, my 46 becomes 56. Okay, so I'm going to click OK. And this is my new trade after rolling. Again, take a look. The risk of this trade was $400 plus. The risk of this trade now is $200 something. So we cut the risk by half. We have a very nice wider profit zone. Okay, and again, as we are exporting ourselves to the increasing volatility into earnings, so this may happen, and we have a beautiful, beautiful, beautiful profit in this trade if all works according to plan. So far, everything is progressing according to plan. Remember, we said those double calendars are strategies where we use multiple weeks to build our double diagonal at the end. Okay, and while the trade is evolving, we are just cutting risk, cutting risk, cutting risk to hopefully end up with a risk-free trade and hopefully with a movement out of earnings report to expand the profit beyond. Okay, so we are here. Okay, now I want to explain the consequence of not doing the roll on AMD, and you get a sign. Okay, before I do it, I need a little bit of feedback from you guys. How is it going? Please let me know how things are going on the chat box. With AMD, I was a bit even a bit faster than HOG. I guess you should have been able to follow, but if it's not the case, let me know. Joe, why not just buy an April 8 123 call to cover and not to worry about selling? Because you don't need to. You already got a 123 call that expires in April 29 that won't expire on Friday. So why would you buy another call? Now you would be in a directional strategy, and if volatility instead of rising was to shrink, you would lose so much on this trade. Instead of reducing risk, you would be increasing risk and change a non-directional trade into directional with an option which is going to be very expensive for sure, because the fact that we are making money on AMD already just by being 1 week into the trade means that implied volatility has been rising. So that's going to be an expensive call. So again, let me clarify. You mean the 123 instead of the 124? Well, yeah, that I would say that would be even worse, in the sense that you are buying an option which is still out of the money but closer to in the money, so it's going to be expensive too. And again, you are not reducing the risk of the trade but adding to the risk of the trade. Okay, so April 8, which expires tomorrow. Oh, got you. But why would you do that? The current price of the stock is 102. The probability of being above 123, 124 on expiration tomorrow is very, very low. Why would you buy an option that probably is going to do nothing? You know what I mean? It's not going to produce anything positive unless price rallies above 123. So that option is going to do nothing. The 124 call you have will expire, and the 123 call you buy today will expire too. You are not naked a short call, Joe. You have a long call together with a short call. Okay, you are not naked. Okay, let me rephrase how this is written. Maybe this will clarify it better. So you own a 124 call that expires in April 29, and you are short the 124 call that expires today on April 8. In my case, it's April 14 because I did a roll. But if you haven't done the roll, that's what you have. Okay. So in other words, when the 124 call expires, you are not naked short an option. You are long the 120 call that expires in April 29. Okay. So there is no problem of any sort by doing that. By rolling the 124 call from April 8 to April 20 to April 14, you are just collecting new premium in, not impacting the margin required to be able to execute this trade, not adding to the risk, but reducing the risk of the trade, because again, you are long the 124 call that expires in April 29, which is a future date. It's a date that is beyond April 8 or April 14. Okay, so you don't find yourself in that position. Okay, yeah, again, there is no issue. Okay, and if I'm not understanding the reason why I kind of feel that you may be concerned, or maybe I'm feeling it wrongly, please clarify to me in the chat box why is that, so I can rephrase it, or maybe I didn't understand your question, Joe. But again, so far, all is good, not a problem. The put side is a different story, though. Okay, and again, I just rolled, so I have no problem. Okay, but what if you didn't roll? So let me explain that. Okay, so now I have the same nomenclature. Okay, so currently you are long the 103 put that expires on April 29. Together at the same time, you are short the 103 put that expires tomorrow. So let's say instead of rolling this one like I did to April 14, okay, let's say you don't roll it because we don't have fake Greeks yet. We don't have distorted Greeks, right? So maybe you wait until tomorrow, and let's say when you try to do it tomorrow, there is not enough liquidity, and you cannot do it. And next thing you know, now Friday closes, and you are still short the 103 put, and the stock is trading, below 103 by 1 cent or less. Currently 102.05, which is almost $1 below. So let's say that's the case. So what's going to happen? Well, you're going to be assigned on the 103 put. You will be assigned. Okay, and therefore what's going to happen? Well, the 103 put, okay, becomes 100 shares of stock at 103. That's what will happen. In other words, you find yourself long a call, long a put, and long shares at the same price. That's what you would have, right? So first, what's the issue? Well, the issue is that being long shares have a great margin implication. You need more money to be long shares at 103 than for you to be short the 103 put while long the 103 put. Okay, you need less margin for that than what you need to be long shares. Okay, now from a risk point of view, do you have any additional risk? No, because what happens if the stock goes up? Well, if the stock goes up, you make money on the shares, okay, but you lose money on the put. Okay, so you make money on that, not an issue. You need more margin, but not an issue if the stock rallies. What if the stock drops? Well, if the stock drops, you lose money on the shares, but whatever money you lose on the shares, you are making it with the puts, because the put gives you a guaranteed exit price at 103. So no matter how much the stock drops, you have a guaranteed exit price at 103 by exercising the put. So you got in at the stock at 103, and you have a guaranteed exit price at 103. So you are not losing anything. The only thing you are losing is the premium paid for the put, which is built in the risk profile of the risk that we have analyzed already for this double calendar. So you are not adding risk by being assigned if you let that happen. You are not adding risk. You are only adding a greater demand for margin and therefore amount of capital available for the trade in your account. And if you don't, you get a margin call, right? So, so you have this situation, if you wish, but you are not increasing the dollar risk of the trade outcome. That is not being increased. Okay, actually, sometimes you get lucky with this. Okay, and while it's not too serious to talk about luck, the reality is that sometimes you get lucky with this. How do you get lucky? Well, you get a sign on Friday, and then on Monday the market opens gapping up or whatever, and the stock rallies, and you don't even need to go above 103. You can go ahead and close the stock on Monday. Okay, let me write it down. So on Monday, okay, you can close the stock and sell a new put that expires on April 14, right? So if the stock went higher, you either made money on the stock or lost less on the stock when closing it. And by selling a put, you are back to get that quantity of premium, which is doing the same effect that we would do if we are rolling today or tomorrow. So not a problem. The only problem again is that you need to go through assignment. Some brokers like TradeStation may charge you, I believe they charge, I forgot, is it $35 per assignment or something like that? Or $15? No, $14.95 per assignment. So that's obviously a pain. So you don't want to go through that if you're using TradeStation or brokers that charge for assignment or exercise. But if you use a broker that does not charge for that, which is the majority, so then not a problem. Okay, and what if the stock goes down? Well, if the stock goes down, you're going to lose more on the stock, but then when you sell the put, you get more. So again, it replicates the same effect of doing the roll before the expiration. So again, not a problem. The only problem is the fact that you may go through a margin implication and you have to have money available in your account. If not, push the roll now before Friday expiration so you don't get into that situation. In my case, now, I don't have April 8 here anymore. I got April 14 and I got April 14. Therefore, on Friday, I'm not going to get assigned anything because I don't have options that expire on Friday. My options expire on April 14. So try to do the roll tomorrow. Whenever you see the Greeks being distorted, this is the roll. So you get the best benefit as possible from theta and the best premium as possible from the next expiration date. And that's it. But again, if you were to get distracted or tomorrow you cannot trade or things like that, just know that you can come back on Monday and then do it then. And it's not the end of the world. The only thing is that you need to make sure you have capital available in your account so you don't get a margin call from the broker, because there is a margin implication by being long 100 shares of stock. So I wanted to rephrase that. We talked about this in prior sessions, but this is important. So you don't get a margin call and you're like, where is that coming from? Or you look at your account and you're like, how come I got 100 shares of stock? Where is that coming from? Well, you are short a put that expires on Friday. If the stock is below 103, you will be assigned. Okay, that's a sure thing. Okay, so keep that in mind. Let me read the questions on the chat box here. Jose, you mentioned you may have trouble buying back the short call. The long 123 is just a workaround. Okay, I get you, but I would still not do it. I understand better the angle on where you were coming from now. Thanks for clarifying this, Joe. Very smart approach, but I would not do it. Why? Because since we're going to get paid very little from that call, any action you take implies a commission to be paid. Already, I am getting paid very little, right? Already, I'm getting paid very little. So if I end up doing this trade and then on Monday again, then I need to sell an option, whatever. So I'm adding more commissions to a situation where I'm going to get paid very little credit. So I will not welcome it, since we are not adding risk to the trade. So it's fine. I mean, if you go purist with math, okay, there is the risk over the weekend, right? So if you do nothing, the 124 call, let me come to the screen again. Okay, if you do nothing at all, the 124 call that expires on April 8 will expire on Friday. If on Monday the market, which is currently trading at 101, was to open gapping up above 124, so now you have more risk. Okay, now you have more risk. Okay, but at the same time, you're also making some money on the 124, and then the new 124 you're going to sell on April 14 is going to pay you more because the market is higher. So, there could be a situation where you add more risk, but it's so crazily unlikely that over the weekend it goes from 101 to 124 that really, to me, it's not a problem based on my trading plan. Okay, again, if you get very pure with the math, I understand the nature of your question, Joe, but you're just going to pay extra commissions for something which is crazily unlikely. And then really, it's almost like, why don't you just give up on the whole call side altogether, right? Because you get so little credit that it's not helping you at all, okay? So I would certainly not buy anything. I would certainly not do any extra action. The reason to leave it for Monday is to not to do any extra action so I don't pay any extra commission. So the 15 cents I'm going to collect, I know is net credit. Still very little, but at least I didn't pay commissions for that. Okay. Good, very nice conversations, guys. I love it. Christian, on the 124 call, TOS offers 11 cents for the call. Take it or insist on 15 cents. Uh, well, I did the roll. I did a roll today. Okay, so in this case, doing the roll makes sense because the Greeks are distorted. To be honest, I'm sure you could have got 50 cents if you looked at this, let's say yesterday or the day before. I'm sure the theta was distorted since 2 or 3 days ago. Theta was distorted. I am sure because that stock has been moving so far away from 124 already since a few days ago that probably you should have done this roll 2 or 3 days ago. You would have got maybe 20 cents, whatever, more than 15 for sure. We just happen to be looking at it today, and therefore that's what I've got. So I'm just doing it. Okay. Jeff, small account cannot do this. Then roll now, like I did. You roll now, no risk of assignment tomorrow. Okay. And you reduce the risk of the trade by half, and everything is working according to plan to put the trade in the position it needs to take advantage of the earnings report. So it's all good, my friends. Okay, all good. Great conversation. I love that we're doing these trades, these exercises, because as you can see out of the questions, there are questions, there are doubts. Some of the questions imply different account sizes. Some of the questions imply a different confidence level because some of you have not seen those trades evolve into earnings enough yet. So I'm loving that we are doing those exercises together because this will open your eyes, and then you will know what to do when you do it by yourself, and then you will do it with confidence. Risk management will be in place, risk will be under control, and not every trade will profit, but you're gonna be okay. Okay, so I'm very, very happy to see your questions and everything else. Mark, with the extra explanation we got, you typed earlier senior moment. Those extra questions probably helped you to be back in tune with the behavior of the trade. Please let me know if that's the case. You managed to roll, Jeff. You got 163. Very nice. Very nice. Mark, so it is okay to let the 124 call expire? Yes. That's the same thing we did with HOG. That's the same thing I suggested for GE. And this is the same thing you could do for AMD, even though in this case, I will not let it expire because, you have bid, you have asked, the Greek is distorted, we are meeting the rules. It's just that I'm doing it 1 day, 2 days too late. If you had looked at the Greeks 1 to 2 days before, you may have got 20 cents, something like that. I'm very positive this is the case. Okay, so I'm just doing it. I will not wait for Monday because I did have an opportunity to do it in this case. Okay, cool. Very nice conversation. Okay, we top of the hour. We actually surpassed it. We have one trade to review. I'm very sorry, guys. It seems that we won't be able to get into planning a new trade today. But anyway, this conversation is critical. Okay, because all those trades, all those double diagonals are progressing according to plan so far. So understanding the sequence or understanding the process is critical. What about LEN? Well, LEN we should be out since a long time ago actually. So LEN is a trade that worked very well, very quickly. I mean, actually the way it was expected. This trade is currently making $180 per contract, maybe a bit less on TOS. What does it show on TOS? LEN shows 170. Okay. Well, this trade is to be closed. Why? Well, we hit target. We actually surpassed target on my end. So I'm just going to close it. Okay. Sell this trade. Okay. I'll try the midpoint first. See if I get filled. Okay. That's it. I got filled. So I'm out of this trade. I made $170 of profit per contract. Congratulations. Job well done. That was the beauty of the plan from the other day. We used the strategy builder. It built the trade for us at the speed of the light. It was all set up for this to happen. The strategy builder was predicting the target to be reached. I believe it was on April 4, I believe it was, and the target was hit on April 5. Okay, so I think it was very well, traded. Very, one of those trades that worked, basically according to plan. The day of exit was that day. the total profit would have been a bit less. Okay, anyone of you guys were in the trade and you exited on time? Because I'm exiting late in this case for my benefit, just getting lucky on this exit. But again, the profit I think was 120 instead of 170, something like that. If you could document that on the chat box, if you could share, it would be great. But anyway, nice one. We got a weak stock with a climate that was beginning in a context where the S&P was likely going to turn around. If you recall, we waited for the evidence of the S&P to break this horizontal line. Some of you were asking about why that horizontal line. Well, it was all because of that Elliott wave turning point. We needed to have the evidence, and that push here was enough to bring the stop where it needed. And nice trade, good example, good trade. I mean, many more to come like this. Nothing magic or special, but good example of the power of putting the rules at work and just managing the risk in the meantime. You miss LEN, not an issue, Jeff. Again, it's just one trade. Hopefully you saw the example and why. Okay, you missed it, Christian. Okay, no issue. I see your MOT icon there. I get it, my friend. This is, to be honest, this as a trader, this is what bothers me the most when I plan on a trade and then I miss it for whatever reason. This bothers me more than a stop out, to be honest. So I get you, but at the same time, when I use the word bother, we need to use it, with a smile on our face. Okay, nothing should bother us in trading, to be honest, unless you had a way to predict the future and you keep making mistakes. Then yes, you should be bothered, or you should feel bad about it because of making mistakes, knowing the future. But we don't know the future, so it's all about probabilities, risk and reward, managing emotions, using the right tools to manage, and just keep doing it and repeat. Right. So no need to feel bad about anything we do because we don't know the future for sure. Okay. So good, guys. My priority here is that you guys learn what we're doing. From all angles, from the use of the tools, from the concepts of trading, concepts of financial markets, the concepts of risk management, the psychology concepts, and the mindset approach. As long as you are learning all of this in the sessions, I'm very, very happy, and I know you are. So in that sense, I'm very happy. And if there is anything else that you need that I'm not providing for you guys, or Josip as well, or Becky, Boyan, the whole team, if we are not providing something for you guys, please share with us. Okay, don't keep it to yourself. Let us know if maybe you need a special session that we do to talk about something specific. Happy to organize those. Okay, guys. Very good, my friends. I'm gonna say goodbye. I don't see more comments on the chat box. I guess all is clear for today. Thank you as always for joining me. As you know, guys, this is a real pleasure for me always when we get together. You had a brilliant session with Josip as well on Tuesday. So hopefully all is clicking, all is working. It's options trader evolution in our sessions. Okay, let me know how things go and what you need, guys. Okay, very good. Yes, Jeff, you will see those double calendars on the last week. Yes. It'll be a good eye opener. Okay, those are strategies that are not addressed too often out there in the industry. Again, I'm not saying that this is a secret sauce or anything like that, but again, most of the times options traders just go for what everybody does, and thanks to the tools we have, we can do more than that. Okay, and this is one example of it. Okay, cool. See you, my friends. Pleasure. See you next time. Bye bye, everyone. Take care.